The stock market's dividend yield is sitting at one of the lowest levels in history, and I don't think most investors realize what that means because a huge percentage of retirements are concentrated in broad market ETFs, and those ETFs are increasingly dominated by just a handful of large technology companies. Now, there's nothing wrong with that. Those are great businesses, phenomenal companies. However, it does mean that investors are relying more on the future price appreciation rather than cash flow of these businesses. In other words, your outcome depends on what somebody else is willing to pay for those stocks down the road versus just income that's being delivered to you over the short term. There's a 38-year study by RBC Global Asset Management which highlights the benefit of that strategy. Lower volatility than the market and a growing stream of dividend payments that you can benefit from along the way. Now, the strange part about that is that these weren't the highest yielding stocks. Chasing high yields turns out to be one of the worst strategies that this study proved. So today I'm going to show you the data. I'm going to explain exactly why this pattern exists, and we're going to cover the biggest mistakes that dividend investors can make. One of the most underappreciated aspects of investing today is actually cash flow investing, not focusing on the potential growth and revenue growth, but actually focusing on profits and cash flow. Before we get into the results of that study, let's quickly talk about what the researchers did. They looked at nearly 4 decades of stock market data. Every year they sorted out the companies into 4 different groups based on one simple behavior. What did management do with the cash flow from that business? Not the earnings growth, not analyst ratings, not EBITDA or accounting measures, just the cash flow, actual profits from the company. Group 1 was the companies that were growing their dividend over time. Group 2, companies that just paid a dividend. Group 3 were the companies that cut their dividend, and Group 4 were companies that did not pay any dividends, no cash flow paid out to the investors. So just one question: did management increase, maintain, cut, or not pay a dividend at all? All right, now let's look what happened. The dividend growers returned an impressive almost 11% annually. The dividend payers returned 9.2. The market overall was at 6.5 over this time period, while the dividend cutters 3.3 and the non-payers were at roughly 2%. So the results here weren't even close, right? It's the same economy, the same recessions. All these companies are experiencing the same market dynamics, the same interest rate cycles, but they just had completely different outcomes. And to put that gap in terms of dollars, percent for 38 years is roughly $500,000. That same 10 grand at 1.9% is only about $20,000. And so that was really surprising, just that delta in returns, but it actually got weirder. Most investors assume that higher returns require higher risk. It's just a fundamental aspect of finance, right? More reward, more risk. Sounds reasonable, except that's not what happened with this study. The dividend growers actually had the lowest volatility of any of the 4 groups. In other words, it was a much smoother ride relative to the non-paying dividend stocks, which had far more fluctuations up and downs over that time period. So once again, the group that made the most money had the smallest swings, and the group that made the least money experienced the wildest swings, which is completely backward from what you would expect, at least what finance theory would teach you. And so that reality is what the market often underestimates with quality stocks, with quality dividend growth stocks. And I think that's exactly where the opportunity is today. And so let's talk about why that happens. I think there's 3 reasons why. Number 1, cash flow is hard to fake. Companies can manipulate earnings, they can create adjusted EBITDA metrics, and they can talk about this on quarterly calls with Wall Street, and they can tell beautiful growth stories with creative accounting. But a dividend requires real cash flow. If you're sending money out every quarter or even every month to your limited partners, to your investors, you actually have to be producing a lot of cash. You can't fake cash. So a growing dividend is one of the strongest signals that a business is generating real economic profits, not fake accounting profits. Everybody knows the Enron story. There's been countless other examples of management teams fudging the numbers a little bit, playing around within the law, even within GAAP accounting, where they will recognize revenue a little bit early, where they will have interparty relationships with companies that they control, and they're recognizing that revenue. They will take large recurring expenses on their income statement and they will capitalize them and move them to the balance sheet, so it looks like they're more profitable than they are. There's all kinds of things that these very sophisticated CFOs and publicly traded companies can do, most of which are perfectly fine. However, they can make it very difficult to see how profitable that company actually is. All right, number 2, management teams hate cutting dividends. They absolutely hate it because a dividend cut gets punished by the marketplace. Investors view a cut as an admission that something is going wrong with the company. So boards stay very conservative. They only raise the dividend when they're extremely confident about the future cash flows of that business and that they can support that dividend increase. And so every increase is management effectively saying, we think our business will be stronger next year and the following years than it is today, which is exactly what you want out of the companies that you're investing in. You want profits to grow over time. And so therefore, dividend quality growth acts as a filter. And companies with excess debt really struggle to grow dividends because they're having to service way too many interest payments. In other words, businesses with inconsistent earnings really struggle to grow their dividend payments. They obviously can't pay out as much cash flow if they're not doing very well or it doesn't exist. And third, this dividend growth qualifier acts as a filter that just keeps out businesses that are struggling. In other words, this filter is letting you select from a pool of higher quality companies. All right, now let's talk about the biggest dividend myth, because this is where most dividend content goes off the rails. The biggest mistake in dividend investing is chasing yield. Everybody loves yield. The internet especially loves yield, and plenty of gurus tell you to go find stuff that's 7-8% dividends in the stock market. But the problem is that can get you in trouble because yield is just a fraction. It's dividend divided by price. That number rises two ways. One, the dividend grows, which is the good way, or number two, the price falls. The market could be warning you that something might be materially wrong at that company if the price is tanking, because future earnings could be in trouble. They could be at risk. And therefore, a simple yield screen treats both of those things the same. In other words, a stock yielding 10% might look attractive until you realize that the market is pricing a major future dividend cut. So the market might have just cut that stock in half, and therefore a 5% dividend yielding company is now 10, but they might even be cutting dividends further from there. And if you haven't done the ongoing research, you might be the last to know relative to the market that is happening. And this is why the dividend cutters from the study we highlighted did so poorly. Only 3.3% annually, and they did that with about double the volatility of the dividend growers. So that's a horrible trade-off. A fraction of the return potential and yet double the volatility, aka risk. In other words, investors had full equity risk, but yet they were getting a savings account type of return. And most investors would have bought those stocks because the yield looked attractive right before the cut. But just you got to remember, high yield is not a sign of strength. Sometimes it's a warning sign. The market often sees these problems before investors do because it's the collective wisdom of a ton of businesses and people. So that's why we spend far more time evaluating the business quality versus just staring at yield screens. A high yield is a question. It's not an answer. It's not a sign that, oh, we have to buy this company. It tends to be much more lucrative to invest in a high quality company that is paying a reasonable dividend, but grows that dividend at a very high rate, often 8 to 10% plus every year. And that's how you get your dividend growth. That's how you get your high yielders. It comes over time, not the first day that you purchase that dividend. All right, so what does all this mean for you? The major lesson from this study isn't that everybody should run out and buy dividend stocks tomorrow. The lesson is that cash flow matters, quality matters, and investors often get rewarded for being boring. In an evergreen, we don't view dividend growth as a standalone strategy. It is one piece of a larger investment framework. Public dividend growers provide liquid income, whereas private investments, real estate, debt, energy investments, they can provide more income at higher yields, many of which are contractual in nature, defensive in nature. And so together they form a portfolio that generates cash flow today and compounds growing cash flow for the future. That should dramatically outpace inflation, while potentially giving you growing, recurring monthly income that you can live off indefinitely and give to your children in the future without ever having to sell assets to fund your lifestyle. So that's the goal. We're not trying to beat the stock market on an appreciation game. Instead, we want to keep up with market returns, but mostly we want to build income that is growing, that generates the vast majority of the returns that you need. And that income is durable, it's lower risk, and so your portfolio over time starts working harder than you do. And according to the study we just reviewed in the 4 decades of data, we believe that companies that consistently grow their dividends deserve a position in your portfolio. Okay, quick recap. The market's dividend yield is near historic lows, and the vast majority of investor portfolios are highly concentrated in just a few technology stocks at high valuations that are going to have to rely on appreciation to get their returns. And those outcomes depend on what the next buyer is willing to pay for those stocks in the future. Now, history suggests that these investors are ignoring one of the most important drivers of long-term wealth, cash flow. And that's a lesson worth remembering wherever the market goes next.